Good morning in the room, and good morning or afternoon for those of you who have contacted us via the webcast. My name is Mark Stride, Head of Investor Relations at Standard Chartered. Welcome to the latest installment of our seminar series, designed to shine a brighter light on some of the aspects of the group that we think will generate significant and sustainable shareholder value over the medium term. I have to show you the disclaimer slide. There will be some forward-looking statements this morning. So you're all very aware of the overall content of these, but just remind yourself. So then I will hand over to Bill, who will give a brief introduction, and then hand over to Simon Cooper. So for the next 40 minutes, you'll be hearing from them rather than me. So with that, hand over to Bill.
Thanks very much, Mark. Good morning, good afternoon, everybody who is on the phone from Eastern regions. A pleasure to be here. Thanks for the turnout today. We've launched earlier this year, as you know, a series of sessions, as Mark just described as well. The Greater China North Asia region earlier in the year was our first pass at a regional overview, and you got a flavor for some of the CIB, Corporate and Institutional Bank, goings on in the GCNA region earlier. GCNA has obviously is a particular set of dynamics which continue to go well as we commented at the half year and the third quarter. The CIB region has also made some great progress, and you'll hear about that from Simon today, but it's a different mix and a different set of opportunities and challenges. The CIB business, as you no doubt are already aware, it's our biggest business, certainly by capital, by income, and should be over a period of time by profits, and has been for much of our past. The opportunities for us in CIB are multiple, and so are the challenges. Simon will go through a bit of progress in his time at the bank, and really the progress in terms of our transformation of our C&I business over the past 2 to 3 years. I'd say that the transformation really began before either I or Simon arrived, but it has accelerated with Simon's arrival and with the arrival of the rest of his team. The business is complex, and it requires some real picking apart, which we've tried to do in some detail in this presentation, and will continue to do in the presentations that we make around full year results, etc. It's also very dynamic. Both the markets in which we operate, as well as the way that we're approaching this business are evolving very, very rapidly as markets change, as opportunities change, and as we transform our bank from what we have been to what we need to be. Underscoring all of that is a focus on investments, actions, and activities that will drive us towards the cost of capital plus return in the medium term. Simon, for those of you in this room and on the webcast, and then the rest of his team in the breakout groups, which will not be webcast, but where you have access to the slides already. We'll get into a fair amount of detail on that. CIB is an important business for the bank, not just in its contribution to our income, our expenses, and the consumption of capital, but also in terms of the business that it drives elsewhere. As you'll hear, the biggest contributor of new clients to our retail business over the past couple of years has come through our employee banking proposition. So corporate clients, primarily CIB, but also commercial banking clients, who are where we have a strategic corporate partnership to bank their employees. It's been a big growth opportunity and an engine for us, will continue to be. You'll hear a little bit about the client drive in commercial banking that comes from leveraging our corporate and institutional bank relationships, so banking our supply and distribution chains or the ecosystem. So the CIB business itself is important. What it throws off into the rest of our business and retail, commercial banking, and private banking is also important. So we'll keep that in mind as well. What I hope you'll come away from today is an ever better sense of what our key differentiators are as a bank with our corporate client segment. And I won't steal Simon and the team's thunder, but you've heard me and Andy talk many times about the fact that we have a differentiated network. It's not just the fact that we are a top-tier global network bank. That's a prerequisite. But that the nature of our network is unique, and especially the position that we have in key markets in Africa, in South Asia, and in other parts of the world, where we're either unique or close to unique in terms of our offering to complicated multinational corporations. This is the key differentiator. And what Simon will take you through in some detail is the degree to which we're now focusing our capital, our resources, our investments on that element of differentiation. And that's a change. That's not the way we approached the business in the past. And as a result, our level of confidence that we can generate sustainably strong growth and returns is as great now as it's been any time, certainly since I've joined the bank. And we think the prospects are exciting, and we're going to share those with you. Of course, there are plenty of challenges as well. The most obvious challenge is the fact that we have a big legacy book. So when Andy and I launched our strategy in 2015, we also announced large restructuring charges, and we substantially cleaned up the big concentrations and have given regular updates on that. But there was a bigger underlying malaise that had crept into our book over a number of years that has to be worked through. So while we've made good progress, and I think you have seen and will see the good progress that we're making on the things that we're investing in, we've also been shrinking the stuff that was broadly defined in a legacy category. And net-net, that's resulted in unspectacular growth and quite poor returns for this business. As we look prospectively, the balance shifts. And much more of all the growth is coming from the things that we're investing in, and the drags that come from the resolution of the legacy situations recedes, which leaves us confident that we can hit this cost of capital plus return in the medium term with the income growth that you will have seen in the quick release of 5 to 7% over our planning horizon. Simon is with his team, the key members of his team today. It's a healthy mix of people who are new to our bank but with extensive banking experience and people who have been in the bank for quite a while, who know the machine and know our clients. That team is gelling. It's come together over the past year and a half, is gelling extremely well from my perspective. Clearly, there's always more to do, especially as they drive their team changes down through their organization. And that's still a work in progress, with key parts of our management team coming in earlier this year. 2017 really is the year to get the entire team fully in place so that we launch 2018 with all guns blazing, and that certainly is the intention. So I'm going to hand over to Simon now, but as Andy, our board, and obviously together with Simon and his team, have looked at this plan, we feel very comfortable that we can drive income growth, that we can do that with much more moderate expense increases, that we can do that with much more moderate capital increases, driving the higher return that we know is required for us to be excited about the business strategy that we got for the corporate business right now. So over to Simon and then the rest of the team.
Great. So thank you, Bill. Hello, good morning and good afternoon. I know many of you already, but for those who don't know me, I'm the Simon Cooper that Bill was talking about. And I've been running the corporate institutional banking business here at Standard Chartered since I joined the bank in April last year. Before that, I was at HSBC, where most recently I ran the global commercial banking business. But I'd actually spent about 30 years at HSBC competing with Standard Chartered in Asia, the Middle East, less so Africa. So why did I join? Quite simply the delta. I could see the potential to drive a massive improvement in shareholder value through applying what I see as the basics of banking to what's a fundamentally strong franchise, as Bill's alluded to, with several natural advantages. So I set out on this slide what I hope to cover today. But what I want you to take away are the following key messages. Firstly, that the longer-term trends in our markets create substantial opportunities for banks with international reach and sophisticated capabilities. The markets in Asia, Africa, and the Middle East are growing at a faster rate than the developed economies in the West. And remember, about 85% of the group's income is generated in this footprint. If you look at the government-led reforms that are taking place and the need for increasingly complex funding and investment solutions, we're going to see a deepening of the local capital markets in the footprint as well. And meanwhile, regional connectivity is increasing, driven by the emergence of complex supply chains, of intra-regional trade pacts, and new initiatives for cooperation such as Belt and Road. Secondly, our strategy in CIB is focused entirely on capturing these opportunities. We're delivering products where we have a clear competitive strength to existing clients, but also to new clients that have increasingly complex financial services needs within our footprint. Thirdly, we have a clear set of priorities to execute that strategy, and they incorporate explicit targets to improve our returns sustainably. We will grow the top line with a focus on quality. We will allocate capital and utilize the balance sheet more effectively, while at the same time improving our funding mix. And we have a sharp focus on efficiency, be that in terms of driving cost saves to fund investment or improving key client metrics. And finally, we're behaving differently to the Standard Chartered that you may have seen in the past. Essentially, we're getting back to the basics of banking so that we can fully realize the potential of the physical differentiation and unique diversity that Bill spoke about. So if you turn to slide 7, most of you will be aware already of what we do. But as a reminder, on the left-hand side of the slide, you can see we serve large corporates with international needs, as well as financial institutions. And we generate a nice balance of income between these two sets of clients, with a slightly higher percentage at the moment from corporate clients. Our focus on increasing the proportion of flow business from these clients should enhance the predictability of future growth. We've got 4 product groups which feed on and draw from each other. And as Bill mentioned, they also play a critical role in the success of the group's 3 other client segments: commercial, retail, and private banking. For example, more than 120,000 employee banking referrals have been made to the retail bank so far this year from CIB clients. While in commercial banking, the ecosystem initiative has generated around half of that segment's new-to-bank clients so far this year. So that's what we do. But to Bill's point, what makes us different? There are only a few truly global banks that can facilitate trade, capital, and investment across all of our footprint. I think the key difference between Standard Chartered and the rest is the geographic spread combined with the depth and the history of presence that we have in those markets. We have a strong and a deep presence across Asia, Africa, and the Middle East, where we have long-standing client relationships, and we have expertise in the products that our clients want, where they want them. And let me come back to that. We're entirely focused on this strategy so it can deliver a clear value proposition. Ever since I've known Standard Chartered, its footprint has been unique. But the bank has not consistently monetized that distinctiveness. So how are we going to do so more effectively and more sustainably? So let me give you a few examples. Firstly, in the past, we were overly focused on serving the needs of clients domiciled within our footprint. We're now expanding our focus to serve more clients that are based outside our footprint, but whose businesses are increasingly linked to it, particularly from Americas and Europe. Secondly, investors are increasingly looking further afield for duration and for yield. There's therefore a strong demand for assets that reflects the growth of our markets. This is something that we're ideally placed to originate, and we're making changes to ensure that we can do more of it. And finally, we're investing to take advantage of the trade and the investment flows that are emerging in our footprint. For example, many of you heard from Ben Hung earlier this year about the relevance of Xi Jinping's Belt and Road Initiative. Remember, we are a leading international bank in China, but we also have a seasoned presence in about 70% of all the countries along that Belt and Road corridor, or those Belt and Road corridors. That's more than any other bank in our footprint. Why does that matter? It matters because working with a bank that is strong at both ends of these projects is a huge benefit to both the provider and the recipient of the investment. That should give us a competitive advantage as this initiative gathers pace. So moving to slide 8. So what did I find when I joined? I think many of you know this. The CIB business had become essentially a take-and-hold operator that had developed some concentrated exposures and was overly focused on top-line growth. And the financial markets business was imbalanced. The transformation of the group as a whole, as Bill alluded to, was already well underway before I joined. It was clear that what we needed to do was to accelerate the transformation of CIB. We needed to secure the foundations of the business and improve decision making. We also needed to take action on businesses that were underperforming. So let me touch on a few of the things that have changed in the past year or 18 months. Firstly, we've significantly upgraded the team with a number of senior appointments, many of whom are here today, who are tackling now their objectives, I think, with real energy. We've completely overhauled the way we prioritize, cover, and serve our clients. We've identified clients with whom we can deepen our relationships. As I said, we're adding new clients to whom our footprint is extremely relevant. And for these clients, we'll be increasingly focused on flow products, cash, trade, foreign exchange. Roberto has begun to address financial markets. The creation of the capital structure and distribution group allows more innovative solutions to be delivered to our clients at the point of origination of transactions, and it also enhances our ability to increase the velocity of our balance sheet and create those market-specific asset classes that I referred to earlier. We've invested much time, money, and effort into improving our conduct and control environment. Our focus now is on maintaining those high standards and actually turning them into a competitive advantage for cross-border US dollars, as an example. And lastly, the way that we allocate capital is now very different. We have a much stricter discipline around allocating capital only to relationships where we see the potential for strong, long-term, risk-adjusted returns. And I'll talk about how we're going to do that in practice, or how we are doing that in practice, on the next slide. One common theme that you may have noticed is that none of these actions are particularly revolutionary. But the reality is that many of these basic banking principles were not being executed previously, certainly not as systematically as they are now. As I said at the start, the attractive long-term trends in our markets have not changed, but we are acting differently to enable our business to capture them. It's quite early days, but the changes are starting to take effect. So on slide 9, as I said, the business needed to make some really tough but necessary decisions in the last couple of years to secure its foundations. For example, we needed to exit businesses, such as equities, where we were not large enough to compete effectively on principal finance. We applied tighter risk tolerances to reduce asset concentrations. As a result, our top 20 exposures now represent about 56% of Tier 1 capital. That's down from 83% at the end of 2014. We also reduced our headcount significantly, taking out around 20% of the most senior managers during the course of 2015 and 2016. That obviously caused some disruption. These deliberate actions removed about $1.6 billion of annual revenue, sort of drag that Bill referred to. But they've left us a much stronger base from which to grow. And don't forget, we did this at a time when industry conditions were challenging, reducing trade volumes and margins, pressure on asset margins generally, considerable regulatory changes, and high liquidity and low volatility affecting client activity in financial markets. The human impact is harder to assess, but there's no doubt in my mind that for a period of time, there was a degree of inertia or paralysis in the bank. And that attitude is now starting to change. We've got a tangible sense of urgency and confidence returning to the firm. So I'm realistic about the challenges, but I'm very optimistic about our prospects. And actually, I think you should be too. So what does that mean as we start to look forwards? One of the things I did when I joined was to ask, how does CIB allocate capital? And I think it's fair to say that the answer I got was sort of unclear. So with my team, I set about redesigning the governance model and the process for capital allocation from the bottom up. I also set up a new team to enable better and faster decision making at the front line. So this credit and portfolio management, or CPM team, has a few clear objectives. Firstly, it reinforces first-line ownership of risk and origination discipline. It provides transparency on the cost and risk of a transaction. And it advises relationship managers where necessary on the optimal structuring of those transactions. But to be clear, the accountability for risk assessment and performance remains with the frontline relationship manager. Secondly, it helps us to reduce profit volatility while at the same time improving returns. So CPM monitors the portfolio for any potential credit issues and helps reduce our exposures through secondary distribution and or hedging. And this plays a key role in reducing concentration risks and in freeing up regulatory capital. So while this has impacted revenue in the short term, it's vital that we carry out these hygiene actions for our success in the long term. And finally, CPM helps us to optimize liquidity and capital resources to support growth. By linking with group treasury and local asset and liability committees, CPM helps improve frontline visibility on optimizing funding, and that's going to be a key focus for us going forwards. So we're already seeing from this a fundamental shift in the velocity of our balance sheet. For example, we have halved the average hold position on underwritten deals since this time last year. So turning to slide 11, I see my role essentially to increase sustainably the returns of CIB, but also to help the other client segments improve theirs and thereby enhance the return on equity for the group as a whole. And I've set out on this slide why I'm confident that we're going to improve CIB's returns over the medium term. I'm going to take each one in turn, but first I want to be clear, while income growth is a key component of improving returns, we're not interested in growth at any cost. Growth has to be sustainable and it has to be increasingly profitable. So the quality of income is paramount. In other words, growth itself isn't the objective. It's the outcome of the actions we're taking to focus on our key strengths and improve our service to our clients, and the investments that we're making to become simpler, faster, and better as a bank. So with that in mind, let me start on the next slide with the first reason why we're confident that we can grow our income profitably and sustainably. You're already aware, and we've talked already, that we're in economies and capital markets in Asia, Africa, and the Middle East that are developing relatively quickly, which is the heart of our franchise. Real GDP on average in these markets is expected to grow at a compound annual growth rate of around 4.8% between now and 2022, driving capital flows and investment. The equivalent rate of growth in Europe and the Americas is around 2/3 of that. So our focus on those markets is on originating business to deliver into our footprint rather than competing head-to-head with local banks. Moving to point 2 on the next slide, we're only going to compete where it makes economic sense for us to do so, meaning where we have the scale and the expertise to add value to our clients for and into our markets and be rewarded accordingly. Each of the tables and charts on this page shows that we are a strong competitor where it really matters for us and for our clients, in trade, in financial markets in Asia and debt capital markets in particular, and in cross-border US dollar clearing. But we need to monetize these strengths more effectively than we have done in the past. And these are not the only examples, as you can see on the next slide. We generate about 3/4 of our income where we have a top 5 market position, and about 1/3 from products where we're a top 3 player. That means that our principal source of income is defensible. You will also see that in the areas we're focused on, we're starting to do well. That's perhaps not so obvious, as Bill said, when you look at the financial results. But as I explained earlier, those results have been impacted by the necessary and deliberate actions that have been taken to streamline and de-risk our business. And speaking of deepening client relationships, that links nicely to slide 15. So here we've set out the multiplier effect on client revenues of delivering our network effectively. We generate nearly 20 times more revenue and a higher return from clients that utilize 11 or more products or markets when compared to those clients that need 5 or fewer. You can see from the percentages in the bubbles at the bottom of the right-hand side, we've been successfully shifting more clients towards the top right by helping them grow and so use more of our products in more of our markets. So how are we doing it? We've been in these markets for many years, if not decades. We've done it by changing in a highly impactful way how we interact with existing clients and by focusing on new clients, including those that were not previously considered in scope for coverage. So you'll hear me and my colleagues today refer to our priority clients in the following groups. The top 100, they're our largest existing revenue-generating clients. The next 100, they're the existing clients from whom we think we can generate substantially more and higher returning revenue. And finally, the new 90 companies, potential new clients that are mainly domiciled in OECD countries that have a large and a growing business in our footprint, where we can offer a distinctive proposition. We've restructured our global subsidiaries team to deliver the network more effectively to our existing clients where they do business. And given that you need to track objectives in order to improve them, the proportion of network income that we generate is now an explicit internal performance metric in each relationship manager's scorecard. So let me give you two actual client examples. We identified a multinational telco in the ASEAN region, one of our 100 next priority clients. Today, we bank that client in 4 markets and across 12 products. That compares to 2 markets and 7 products 2 years ago. I was going to tell you what the multiple of revenue was, but we decided that was too big. But we now earn a multiple of the revenue that we used to from this client, a significantly higher return. Another example is a North American pension fund. That was not previously a priority client. In a year, having identified it as a next 100 client, we've almost doubled our revenue. We've gone from practically no relationship to providing 5 interlinked products, including cash and foreign exchange, across 5 locations in Asia and Western Europe. In both cases, proper prioritization and alignment across relationship management and products has driven real, tangible results. I won't go through all of the growth initiatives that are set out on this slide 16, but suffice it to say that all of them have either been set up or substantially accelerated within the last 18 months, and many are already starting to show tangible results. As I mentioned right at the start, the relatively rapid economic development in our footprint is accompanied by growing demand for complex financial services. Many of our initiatives are designed specifically to capture this structural long-term growth opportunity. For example, we've onboarded 80 of the so-called new 90 clients that we targeted initially. And obviously, we're not going to stop there. We've generated more than $600 million of revenues from Belt and Road, RMB, and other China opening initiatives. So this isn't luck. These initiatives and others like them are now a fundamental part of frontline relationship manager scorecards. Moving to slide 17. I stressed previously that we're only interested in growing what we refer to as quality income. To me, higher quality means more predictable, more repeatable, less capital intensive, and therefore returns enhancing. So in a competitive world, that's not easy, but we are executing our plans diligently, and you can see the progress we're making in driving high quality income in the 4 charts on this slide. If you take a look at the top right-hand chart in particular, we identified 2 years ago that our funding mix was not optimal. So to help address that, we focused on gathering a higher proportion of corporate operating accounts. Not only is this a more predictable and repeatable source of funding, it acts as a platform for cross-selling other products and tends to attract favorable regulatory treatment. It also positions us to benefit more from interest rate rises, and I'll come back to that later. Getting our cost of funds down will be an important factor in improving our overall returns going forward, and this initiative, where you can see we're already showing good progress, will feed into that. And of course, the rate of improvement isn't going to show linear tracks in every respect, but we're taking assertive action to deliver a better business for you, shareholders. You'll all be aware of the potential headwinds and tailwinds on this slide. We don't know exactly how each will play out in the medium term, but what we do know is that what we must do internally to improve our performance and to make ourselves more nimble. This will mean we're able to better take advantage of tailwinds when they occur, as well as to be more resilient in the face of headwinds. Let me just touch on the first tailwind on that list, interest rate sensitivity, because I know that's particularly topical. So you've been told previously by Andy that Standard Chartered should generate around $300 to $400 million of additional revenue a year for every 50 basis point increase in the Fed rate. That obviously involves all sorts of assumptions, including all other local interest rates where we hold quality liquidity will follow suit, which, as you know, has not yet been the case. And as Andy explained in the half-year results, we have seen benefit of the rate rises so far that have come in US dollars at around the level we anticipated and guided. And for CIB in particular, you see that coming through in our cash management business. But part of the reason for that is also our conscious decision to focus on higher quality liabilities. We've had a lot of practice now at addressing regulatory change. And so while uncertainties remain and we can't foresee the future, we now apply much more discipline around driving more predictable and more stable income and optimizing the shape and the mix of our balance sheet to hopefully minimize the impact of those changes as they come. So having covered the main income drivers of generating sustainably higher returns, what do I think the franchise is capable of producing in terms of top-line growth in the medium term? So I said earlier that real GDP growth across our markets is forecast to be 4.8%. So I think, given all of the improvements and changes that we've made in the last 18 months, we should be able to grow our income for the business overall, at least at that rate. So in the medium term, based on that GDP outlook, I think a 5 to 7% compound annual growth rate in income should be achievable, with a slightly higher rate on a risk-adjusted basis. So let me turn to the next driver of higher returns, expenses, on slide 19. So as you know, we've taken substantial costs out of the business over the last 2 years, while at the same time investing to secure the foundations and to start becoming more lean, more focused, and innovative. The investment blocks that you can see in this chart show the P&L impact. The cash investment has been higher than this. So to begin with, I think the majority of the investment has been on regulatory projects and on fixing rather than improving systems and processes. And while we're going to continue to invest in the control environment, of course, and that's existential for our business, as I said earlier, to some extent it's becoming a competitive advantage. Generally, as I look forwards, I expect the ratio to normalize. So a much higher proportion will be spent on strategic projects that will help us to improve returns sustainably. The strategic investments that we've made in the last 2 years are already starting to show results. For example, we've reduced the client onboarding time from around 31 days in 2016 to around a dozen today. That makes a real difference to our efficiency measures, and importantly, it makes a real difference to the experience of our clients. So looking forwards then, cost inflation in our markets is currently running at about 3% a year. We're going to continue our tight control of costs in CIB and intend to restrict cost growth to at or below that rate, even allowing for continued investment in systems and products that we've planned. So on slide 20, let me spend a minute on the other main driver of sustainably higher returns, optimizing risk-weighted assets. You'll recall, back in November 2015, we identified a portfolio of low-returning clients in CIB with $40 billion of risk-weighted assets. We've worked really hard at addressing those risk-weighted assets, and on a gross basis, we reduced that initial stock by about 3/4. However, the gross reduction has been more than offset on a net basis during that period by inflows of RWAs that generate a sub 3% income return on RWA. That's come about through conscious client actions and onboarding, credit migration, market pressures such as margin compression and model changes. And given that we've reduced overall RWA in the meantime, the proportion of suboptimal returning RWAs has actually gone up since 2015 to just under 17%. So despite our success in addressing the original target exposures. So clearly what we must do is to focus on reducing the proportion of suboptimal RWAs over time. That's how we improve our returns sustainably over the medium term. So you will be able to track going forwards how we're getting on with that objective every year. So in summary, I'm confident that we can deliver a sustainably higher return on RWA going forwards. As I said, I think this business has the potential to generate income at slightly above the rate of GDP growth in our markets over the medium term. That means a compound annual rate of between 5% to 7%. We're going to maintain our disciplined approach to costs, managing expenses growth to below the rate of inflation, thereby creating capacity for strategic investments. Meanwhile, we will reduce suboptimal returning risk-weighted assets as a proportion of total risk-weighted assets, thereby freeing up capacity to redeploy where we see returns accretive opportunities in our client base. So let's turn to slide 22, which you will be delighted to know is my penultimate slide. So to show you that this isn't just talk, I wanted to show you the key business priorities from my own scorecard. And you'll see that they're grouped into the three themes that you've heard me speak about at length today: growth, quality, and efficiency. So my incentives are linked directly to improving your returns. The targets within the three themes cover many of the topics that I've mentioned already: prioritizing growth and new client acquisition, strengthening leadership in our markets and key products, managing the balance sheet more efficiently and effectively, and strengthening the risk and control environment. It's also got measures for initiatives that are equally important that I've not covered today. So digitizing to improve both the client experience and our own efficiency, enhancing talent diversity and our ability to embrace cultural change. So let's turn to slide 23 so that I conclude. So, in conclusion, we are confident that we can deliver sustainably improved returns in the medium term by enhancing the quality and growing the quantum of top line, by maintaining our discipline on expenses, and by finding more attractive opportunities to redeploy low-returning risk-weighted assets. So hopefully those messages, those that explain why I'm confident in that trajectory, came out clearly as we went through the slides, but just in case, here they are anyway. One, we have a unique presence in markets where the longer-term trends remain attractive. Two, our strategy is focused entirely on capturing the opportunities that those trends create. Three, we have a clear set of priorities to execute that strategy, and they now incorporate explicit targets to improve our returns sustainably. And lastly, but by no means least, we are behaving very differently to the Standard Chartered that you may have seen in the past, executing the basics of banking far more rigorously and far more systematically. So thank you for listening. I look forward to engaging with you more during the rest of today and in the future, and to give you updates on how we're doing. Thank you.